Good afternoon, it's John Mousseau. I'm the President and CEO of Cumberland Advisors and the Director of Fixed Income. It is Friday afternoon, May 29th. Very quiet week in the bond market. Treasury yields not moved very much at all. 10-year bond around a 0.66, the 30-year bond around a 140. Very little movement. What's a little different this week is very little movement on the municipal bond side. Maybe yields down 2 or 3 basis points. So a continued narrowing of the spread between Munis and Treasuries, but not much. But we can expect that to continue as we move on to the rest part of the year. For the most part this week, we saw a pretty good equity market. My colleague Matt's going to talk about it. But in any case, what you're really seeing is the fact that demand for muni bonds has returned. Some bonds have been left a little bit behind. Think about bonds backed by transportation or airports or universities, private universities, or stadiums or convention centers. Bonds like that are off in their own universe somewhat. They have not come back. That's going to depend on the degree of economic recovery that we do get as we go forward. Numbers this week, as you would expect, durable goods numbers disappointing. Initial jobless claims more, 2 million more, but the amount of initial jobless claims a little smaller than we've had the last few weeks. So incrementally the jobless claims are getting smaller. That's a good sign, something you would expect to see as we go forward, as economies return. We saw New York this week talk about another phase of coming back. Here in Florida, Sarasota, Florida, we've come most of the way back. People have not returned to offices, but most businesses are open. So across the country, things continue to open up. We see that reflected in the stock market moving a little higher. We see that in the bond markets between spreads on corporates and munis coming down. We are a long way from the distress levels that we saw back in March, where you could see a 2 or 3 year municipal bond trade at 3, sometimes 4 times, sometimes 8 times the amount of a Treasury security. Crazy, right? That's pretty much down to even or munis being lower. So that part's totally recovered. Longer end's going to take some time to recover, but again, much narrower than it was. So overall, a boring week. We like boring after all the volatility that we had earlier this spring. So on that note, we hope you all have a very great weekend, and we'll see you next week.
Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors, May 29th, just after the close. Closing in on the month of May. Solid month, good breadth, expanding breadth. Nice to see small and mid caps get a bid versus large cap. Solid across all 3 areas, but as we know, small and mid have been so weak in comparison that it was encouraging to see a bid. We'll see how long that lasts. Wanted to share a couple of charts with you today. Sometimes when markets are as strong as they are, you scratch your head and say, why is this happening? How is this happening? Look at the headlines. Don't people understand how bad things are? And those are very normal internal conversations you can have with yourself, and we have them all the time. Try to lean on some analytics and data to help us out, to try to have a flexible view. As I mentioned last week when I went over our allocations, we do hold cash anywhere from 6 or 7% in international up to 15% in our U.S., and our tactical is in the 30 area. You know, they often say, an old saying, grew up with this, is the strongest markets never let you in. And I've been seeing that on a daily basis. And vice versa. The weakest markets never let you out. How often have you said to yourself in a weak market, if I get a little bounce here, I'm going to become a seller? And that bounce never comes. Well, we're in a very strong market, and that's what I want to share with you today. The first chart that I'm going to put up is the 10-week chart of the S&P. And what this measures is the percent of stocks in the S&P 500 currently trading above their 10-week moving average. That's a very, very strong market when you crease 90. And what we are looking at right now is a chart of the 26 prior times, dating all the way back to 87, that the S&P the stocks in the S&P had a reading of 90% or better of trading through their 50-day or their 10-week moving average. To add to that, on Thursday, the number increased 95%. That's the highest ever recorded. Just giving you an idea for how strong this market is right now. In terms of that, often my initial thought would be, okay, we're going to get a pullback. We've gotten ahead of ourselves. Maybe I should be selling into some of this strength. The point of this chart is to show you that although charts are just possibilities, not certainties, that kind of action does have pretty good carry through longer term. If we take a look at the occurrences from 87 through last year, very positive 6, 9, 12 months out. I've highlighted for you a couple of the times where negatives jumped out at you. There are no certainties when we look at math, when we look at data, when we look at past trading patterns. There are no certainties, but there are possibilities. And that flexibility to possibilities, very important. So we're seeing strength off the charts, and as you can take a look at the average, the median down below, that kind of strength has carry through. So we need to understand that there's some precedent for continued strength. When we take a look at the second chart, what we're going to look here is when the S&P trades 10% above its 50-day moving average. When the S&P trades 10% above its 50-day moving average. Very rare. How rare? It's only occurred 6 times since 1955. Think about that. The occurrence that we're seeing is so rare that the sample size is 6, dating back to 1955. And what's happened once the S&P has traded through or beyond 10% of its 50-day moving average? Decent returns, pretty good returns. A little bit of weakness, a little bit of pullback, and that's what we may see. Started to later in the week, this week. Market rallied off of Trump's comments being less severe towards China than anticipated. But take a look at that chart and take a look at those numbers. 6 and 9 and 12 months out, 2 years out are breathtaking. And certainly this period is not going to duplicate or act at all like previous periods. But there is precedence for strength. Strength begets strength. Sometimes clients or even in the office people will say, why is the market down? Why is the selling going on? And I say selling begets selling. Strength begets strength. So from my cash standpoint in our strategies, the way I need to at least respect the market here is that I want to be a buyer on pullbacks. And that's something we speak about all the time on these videos. We want to buy great stocks. We want to buy great indexes. We want to buy great sector ETFs on pullbacks. Strong names on pullbacks. Let's see what next week brings us. Have a great weekend.